Wow, look at it back here this morning. Supposed to be editing a video on covered calls, but it's kind of hard to ignore mornings like this. Too peaceful, look at that. It's too nice. Too nice to talk covered calls. Well, but that's, I guess, what we do. Hi guys, welcome back to the channel. My name is Dave and we're going to be jumping right into a review of IVVW from iShares or BlackRock. I know your favorite. But I've been getting lots of requests for different ETFs recently, and I've been keeping track of all of them, and I thought I'd start knocking out some of them. So on the list, I know I have YMAX, one of those crazy ones from YieldMax. We'll talk about that. GIAX was requested, TYLG was requested, TSPY has been requested, and this one. So I've got a growing list. I thought I'd start knocking out a few of them and talking about their strategy a little bit. A lot of these fall into that income category or covered call strategy kind of category. I've talked about, I think, 20 of them or so far. At some point, I'll categorize them all based upon maybe their underlying and my overall opinion of them. But just trying to knock out some of these that have been requested to give people some information, or at least my viewpoint on these particular products. So in this case, it's IVVW, and this is a really vanilla strategy that uses a covered call strategy. So one of the things that really sticks out to me that I like about it right off the top is that it has a very, very good expense ratio. 0.25% is very affordable. When it comes to the covered call space, this is about the lowest that I've seen. So yeah, that's a good thing. One check mark for IVVW. But yeah, so what is this all about? Well, it's target enhanced income, diversification, easy access, blah, blah, blah. What is it really? Well, it's going to own the S&P 500 by buying IVV from iShares by BlackRock. That's right. They're going to buy their own product. That's the guts of what this is about. So it's going to own the S&P 500. Just think like VOOSPY, or in this case, IVV. Exactly the same product. Very inexpensive to own, and you're a part of those 500 stocks in the S&P 500. So great way to start. Then on top of that, they're going to layer their option strategy. So in this case, and I'll put some things up here from the prospectus, but you can dig into it more if you would like yourself. But it's going to sell 30-day out of the money index options. Therefore, we get that favorable tax treatment. So that's one of the nice things about this fund as well. We're going to get that 60-40, 1256 contracts tax treatment. So 60% long-term and 40% short-term for those that aren't aware. And that will flow through to you come tax time, provided there's not ROC, which there will be probably with this one. I imagine there has to be. But 30-day contracts selling out of the money by 1%, and then they're going to roll those options the day prior to expiration to the new contract. So again, about as vanilla of a strategy as you can get when it comes to option overlay. So completely mechanical, reminds me of XYLD, which is another one that I'm not a huge fan of because there's just not a lot of intelligence behind it. But if it meets your objective and it's very inexpensive and it does use, index options, maybe it's something that would work for you in conjunction with some other products. Now, if you're not familiar with how options work, I'll give a better explanation towards the end of the video, but I first want to jump over here to Seeking Alpha and talk a little bit more about IVVW from iShares. So I am a Seeking Alpha affiliate. There are affiliate links down below. I always mention this, if you're looking for a stock and ETF research tool, this is a great one. It's the one that I have open on my browser all the time that I use to research information. And when something happens, like Powell comes out and cuts interest rates, for example, you have a nice little banner pop up. If you're looking at alternative products such as this, there's usually really good information that you can reference down here that when people review these products, and it's a great resource. So I recommend it to other people, and it's what I use. So anyway, IVVW, we can see it's only been out since March of this year. The expense ratio is very attractive. It pays every single month. People love that idea. The yield shows 10.5%, but that's not even a full year. So if you annualize that, we'll look at it here in a little bit. That's about 15%, so pretty attractive to people. And the assets under management are around 27 million right now. So you can kind of see it's treading water so far. So it started back here right around $50 and it's sitting right around $50. So it hasn't gone anywhere. in a rising market. And we'll talk more about that when we cover the option strategy as well. But that's the guts of what we're looking at right here. And let's take a look at the dividends as well. Now, for most investors that are interested in products like this, the primary driver is the income. It's that distribution that they get on a monthly basis. So Seeking Alpha, you're going to click on the dividends tab, and it's going to give you lots of the information that you're looking for. In this case, we have a dividend summary that says, hey, 10.55% based upon the first 8 dividends or distributions that they've paid out. And the last one was 62 cents, and the ex-dividend date was 11/4. And don't forget, if you want to get that distribution, you have to own it before the ex-dividend date. So 11/3. X means no longer yours, right? You have to wait for the next one. And they pay that out a few days later. So soon after you qualify for that dividend, you're going to get that payment, and it's going to be coming out on a monthly basis as well. So we can look at the dividend history, and we can kind of see what the first 8 looked like. The dividend history looks like this. It's kind of all over the place, right? So if you're familiar with some of the other products that fall into this category, some, I guess PYI, for example, they try to hold their dividend very steady. Other ones like JEPI, they're more up and down like you see here. So if you're counting on a certain amount every single month, this might not be a good one for you unless you're blending it in with some other products. Because from what I can see here, we got one that's 36 cents, and then a month later, it's almost triple that, right? $1.01. So across all 8 months that they've had these distributions, that averages around 66 cents. And that gives us an annualized yield, if we extrapolate out for a full year, to 15.7%. So that's pretty significant. That's a large number. And then we're going to have to wait and see at the end of the year when we get our tax information to see exactly how that's being paid out to us. And let's check out performance of IVVW going all the way back to inception back in March versus some other covered call ETFs that we've talked about in the past, and the underlying index as well. So if we just look at price return, which is what we have up here right now, since inception, IVVW is treading water up about 0.5%. SPYI, another fund we've talked about quite a bit, up about 4.7%. GPIX, again, different covered call strategy versus SPYI, and this one's up 8.78% during this time, so pretty good. XYLD, I'm not the biggest fan of this one. I haven't talked about it directly, but up 3.82%. This one sells, I believe, directly at the money, whereas this one sells 1% out of the money. And then we have IVV, just the index by itself that this is based upon, up 16.62%. Outstanding performance during a bull market. It's doing very well. So I would expect that, right, we're going to see that big difference when we're just talking about price return. Now let's factor in all those distributions, dividends, back into these products and see how they did. So for that, with Seeking Alpha, you just click on metrics, take out price return, and you look at performance here, and you say total return. Factor all that back in for me, and voila, you get your graph here with all that factored back in, and we can kind of see that we're much closer with all these products. But they're still going to underperform IVV in a bull market, and that's been the case. Unless we're just kind of trading sideways or we're on a slight decline, you're going to see better performance by owning the index itself. So in this case, it's up about 17.8%. And if you look at some of these other ones, IVVW up around 11 to 12%, pretty respectable, really. SPYI up 13.5%, pretty good. GPIX up over 15%, so that's the best of the covered call funds that we're looking at here. And then XYLD lagging behind everything at 10.8%. Again, selling at the money. Not my favorite strategy. Again, 1% out of the money, and you kind of see those lagging. Something that has maybe just a little bit more intelligence behind it with their option strategy. It's not always going to be this way, but in this case, that's what we're seeing. So yeah, that's performance, IVVW since inception. So if I was really determined to add this to my portfolio for that income, how would I utilize this particular ETF? Well, I would pair it up with the underlying IVV, and I'd make a little bit of a compromise here in order to try to build out a better version for myself. So this particular one, selling 1% out of the money, gives you very little upside. It caps it right away. So let's think about this. Let's say we went 66% IVVW and we put the rest of our money, 34%, into IVV. In that case, we're going to still have about a 10% overall distribution, being 2/3 to 1/3. And it's going to allow me to be a participant when we have big, strong market moves. So this week is a great example, right? We had the election here in the United States, and right after that, we had a nice big move for the last 3 days of the week. So I want to be a part of that. So by doing this, I'm still going to get 10% of that income being stripped off, but I get to benefit from those big, strong market moves. And I get to tell my friends that I just created this incredible income ETF, and it's the lowest expense ratio out there, right? Because combined, you're going to have that 25 basis points plus IVVs, I think 0.03 or 3 basis points. It's going to give us something under 20 basis points combined. Incredible, right? We've just built a better version for ourselves that will also allow us to have some growth. Now, I do want to talk a little bit about the covered call strategy with this particular product. I'm not a fan of robotic option strategies like this that just sell 1% out of the money and repeat this every single month. They don't work. There's no intelligence behind it. I've compared it before to Wreck-It Ralph and a China shop swinging a bat. That's the kind of idea. It's not refined. If you were the person that was doing this option trade, you would not do it that way. So I put your money into something that's going to do it like that. So if I was going to go the route of adding this, not only would I pair it up with the long for some reasons, I would also pair it up with some other strategies that are similar to this as well. So, we've talked about SPYI, right? That sells out 6 weeks into the future, rolls them after 4 weeks. They don't sell against the whole notional, and you see better results with that one. GPIX, same thing. It doesn't sell against the whole notional. It sells closer to the money, though, than SPYI, I believe. DIVO sells against certain assets that they have, but not against everything, again, allowing for some growth. So by mixing all these together into the soup bowl, I think you're going to have better results. I just don't like the strategy that's behind this where it's completely robotic and you're at the mercy of a swift decline. So when these are really, really poor is when the S&P 500 drops 10%. That's an exaggeration. Let's say 5 or 6%. And then it comes right back up 5 or 6% the next month. If you just owned IVV, you'd be break even, no problem. But if you own this and you lock in and you sell 1% out of the money when you have a large decline and there's no thought behind it, then it can really hurt you because you're not going to get that. But when you come back up to that value, you're not going to be able to reclaim all that. So you could actually have a loss there. Whereas if you just own the underlying asset, you would have been fine. So that's why I say pair it up with the long and think about the strategy that you're using. Overall, by putting all of these together, it can make more sense. And again, soup bowl concept, where several of these are together with different expiration dates, further out of the money, those types of things, can pay off for you better in the long run, in my opinion. Anyway, that's my 2-cent review for IVVW from iShares. So let me know down below what you think about this particular product. Now, they have another sister product to this, which is IWMW. So if you like this one, same idea, same concept, but based on the Russell 2000, check that one out as well. So let me know what you think. If you like this type of thing, like and subscribe. And if you have an ETF that you're considering, that you're like, I'm not so sure, but I wonder what Dave thinks, let me know and I'll eventually get around to it. Hopefully more of these will be coming out soon. So like and subscribe, and we'll see you next time. Have a great night. Baby boop. Baby boop. Whoop.